You are mathematically programmed to lose money at the exact moment you feel the smartest. Retail investors do not buy the top because they are stupid. They buy the top because institutional algorithms are explicitly designed to manufacture FOMO. When you see a massive green candle, your brain sees an opportunity. Wall Street order flow models see exit liquidity. Today, we are opening the black box. We are going to look at the exact quantitative mechanics of how institutions use order flow to exploit your psychology. Welcome to Quant Logic. Every market cycle ends the exact same way. Record retail inflows meet massive institutional distribution. But why does this happen with such perfect timing? To understand this, we have to stop looking at price charts and start looking at order flow data. Price is just an advertisement. Order flow is the actual transaction. When you look under the hood of the market, you realize that FOMO is not just a feeling. It is a highly engineered liquidity trap. Let us break down the math. Institutions have a massive problem. That problem is size. If a multi-billion-dollar fund wants to offload millions of shares, they cannot just hit the sell button. Doing so would crash the price and destroy their own profits. They need buyers, lots of them. And they need them precisely when the asset is most expensive. This is where algorithmic market making comes into play. Algorithms do not just react to the market, they shape it. By systematically painting the tape with aggressive buy orders at key technical breakout levels, they trigger retail alerts. They create momentum. And what happens when momentum builds? Retail volume spikes. You think you are catching a breakout, but you are actually stepping into a carefully laid trap. This brings us to a metric called Cumulative Volume Delta, or CVD. CVD measures the net difference between buying and selling pressure. At market peaks, a very specific divergence occurs. You will see the price making higher highs, but the CVD begins to flatten or even drop. What does this mean? It means limit orders are absorbing market orders. Retail traders are market buying the breakout, slamming the ask. But institutional algorithms are sitting on the offer, passively absorbing every single buy order. They are feeding the ducks. The price goes up on low volume to trigger your FOMO, but the heavy distribution happens invisibly via limit orders. You are literally providing the exit liquidity for the smart money. But equities are just one side of the equation. The real weaponization of FOMO happens in the options market. Retail traders love short-dated, out-of-the-money call options. They treat them like cheap lottery tickets. When retail buys these calls in massive size, market makers who sell them are forced to hedge. They do this by buying the underlying stock. This creates a positive feedback loop known as a gamma squeeze. Price goes up, forcing more hedging, which drives the price up even further. It looks like an unstoppable bull run. But institutional quants are watching the options chain closely. The exact moment retail call volume peaks and begins to decay, the dealer hedging reverses. The floor falls out. The algorithms switch from buying to aggressive shorting, riding the delta wave down. Your call options expire worthless, and the house profits on both sides of the curve. FOMO is not a mistake. It is a mathematical mechanism designed to transfer wealth. Whenever you feel that uncontrollable urge to buy a parabolic chart, remember what is happening in the dark pools. Remember the CVD divergence. Remember the dealer gamma exposure. The next time you are tempted to chase a breakout, ask yourself one simple question. Are you riding the trend, or are you becoming the liquidity? Stay analytical, manage your risk, and stop trading on pure emotion.